Hello listeners, and welcome to the Montel Weekly Podcast, bringing you energy matters in an informal setting. In today's pod, we will discuss carbon markets, current developments, and the outlook for prices, which remain very volatile. I think it's fair to say that the market's been very choppy, with prices hitting 2-year lows in February, before returning to levels between 65 and 70 euros. In fact, about the same as when we last had this week's guest on the pod. Could prices rise to 100 or sink to 50 euros, or perhaps somewhere in between? Helping me, Richard Sverrisson, to discuss the key issues in Europe's carbon market is our old friend and regular guest on the pod, Ingvild Sorhus, now of Veyt.
Thank you, Richard. It's a pleasure to be here.
Perfect. You're very welcome as always, Ingvild. Now, let's start, I think, the sort of big picture about emissions in Europe. They fell quite dramatically last year, didn't they? How much did they fall by, and what were the main reasons for that fall?
So we don't have like the final number, but it looks like the emissions were down 15.5% year on year for 2023. I guess it was a bit of a twofold. We saw the biggest decrease in the power sector. That was both more renewables coming in, but also a lower demand picture across our lower electricity demand. And most of the year as well, we saw that, coming out of winter in 2023, we had a quite healthy gas situation, and then gas prices were dropping, and then we saw gas being in the money rather than coal. So that kind of amplified the decrease in emissions in the power sector. And then, of course, we saw a big drop, or a rather drop in industry emissions as well. And that was mainly due to lower activity. Starting the year was a bit more optimistic, thought it was at least going to be a small increase in industry activity. So that was those two sectors that was responsible for the big drop. The sector where we did see an increase was aviation. So flying activity across Europe increased compared to where we were at the years like pandemic and post-pandemic.
So people are flying again. That's the essence there. And have emissions ever dropped to that scale before on a year-on-year basis?
No. So that was the steepest drop. We have seen drop before, like with COVID, and we have seen after in 2019 we saw a big decrease in emissions due to fuel switching, but we've never been to these low levels before, like the total emissions for the EU ETS in history.
No. And do you think this is going to be a one-off, or could this be repeated again?
It might very well be that we're on the path to a lower emission future as well. We see just the development for emissions in the power sector this year. We see them or estimate them to be like around 24% lower at this point in time compared to where we were last year. Of course, we started the year with like more coal to gas switch already from the beginning of the year, but also more increase in renewable generation. So like just emissions were dropping quite significantly in the power sector last year, and we see a further decline this year. Of course, we need to see also a quite rapid decarbonization in the power sector in the years to come as well. But then I guess it's also the question on what level will industry come back at, or the industrial activity.
And do you expect some of that to return? Or now, there's a lot of talk of demand destruction. I see numbers up to 15% demand from industry down for energy. Is this something that you think is also reflected in current carbon market dynamics?
I think yes. I think because of overall, we look at quite a bearish year, I would say. That is reflected in the prices. As we have seen, we saw a big decrease in emissions last year, and then we see a continuation of that this year, and also with more supply coming to the market. So that really reflecting what kind of levels we have been with carbon prices, just looking at short-term dynamics. And of course, there has been uncertainty also over the European economy as well. When will it pick up? It's 2023 became less optimistic than when you started 2023. So I think it's a bit wait and see. And of course, some of the industrial activity might not return to where they were before the energy crisis and the Russian invasion.
And of course, some of that industry may be becoming more or increasing energy efficiency as well, and their kind of processes are changing.
Yes, of course. So that's kind of part of the picture as well. With kind of the energy crisis probably also was speeding up kind of some of the energy efficiency improvement that could be taken by industry as well. And then some might not see a future in Europe, that might be both power prices, demand that has been dropping in or kind of demand for different goods in Europe. So it's kind of a bit kind of mixed picture.
And I mentioned in the intro that and you're talking now about the sort of kind of bearish momentum in the market. What prices dropped to €50 or around €50 in February. But why have they rebounded so sharply? Because now we're around between 65 and 70 anyway, aren't we?
Yeah, I think this week we've seen prices testing like 70 again. So of course we have seen big volatility, and all of this year we've seen it's been really like tightly correlated with gas. And of course with the uncertainty and a bit more nervous gas market, carbon has reacted to that as well. And I think it's a bit, because I mean, if you only look isolated on 2024 and 2025 perhaps, and then it's quite kind of oversupplied market. We see drop in emissions, and then 26, 27. So it depends on the horizon you're looking at, because then we're getting into shortage, and then we're getting into quite heavy shortage in these years. So it depends on how the market participants are valuing a bit. When do they start factoring this and these kind of shortages or future shortages? So that's a bit mixed, but I would say that it's mainly been driven by kind of the uptick in gas prices, or at least that has been the trigger of prices moving higher. And then it's quite volatile and technical driven. And then, of course, there are, for instance, investment funds have had quite big short positions. And when you talk about these big price movement, that there are short covering in the market as well. So yeah, it's and then on top of that, in the uncertainty of the Repower EU, which is, of course, when prices are increasing again, then will be less supply that needs to be added to the market as well. So it's it's a bit difficult. I think it's a difficult times for the carbon market at the moment to pinpoint the real kind of the proper level.
I think we'll touch on several of those issues during the course of our conversation, Ingvild, but explain to the readers what's the link to gas prices? Why is carbon so closely correlated? I mean, we mentioned a little bit before we started. We're talking about the chicken and egg kind of situation. But so what's the why is gas so important for carbon prices?
Yeah, good question. I mean, ideally, like in the past and like textbook example, it's like the fuel switching levels that is setting. Is a price setting setter for the carbon price, and by fuel switching, what kind of level the EUA price needs to be to switch from coal to gas, so less emissions in the power sector. Of course, now fuel switching levels are super low, so carbon price could be so much lower. So even if the gas price is moving, I mean, carbon, by no means should really be that closely correlated with gas. But I guess the participants are engaged in both market, and for now it's been no really other kind of big drivers for carbon. So then it's more kind of a price taker of gas.
Because it may seem odd to some people, who are looking at the European carbon markets and thinking, okay, there's been gas prices are moving up on an escalation in the Middle East and the crisis developing there, and potential of conflict between Iran and Israel. But then why on earth should that drive European carbon prices? That's the question.
Yeah, and I guess that has been the case earlier as well. Then it might not be correlated to gas, but I mean, after the pandemic and when Europe was closing down, suddenly when everything else was going down, carbon was going up with macro and whatever was happening on the macro side on the US, perhaps, and sometimes has followed oil. So it's a bit kind of schizophrenic, I would say, sometimes without kind of the lack of real fundamental drivers. It's shifting a bit on what's the main drivers of carbon. And for now, it's been super correlated with gas.
I mean, does that make it harder or easier to analyze from your perspective there, Ingvild?
Yeah, I think it's a bit, I would say, slightly harder. Also because it's, we see fuel switching becoming less and less relevant as a price setting element for carbon. Of course, the next few years, you need to have quite a lot of gas or coal switch over the next few years. So in that sense, it is some price setting element to it. But now, if the price should have been the EU or the carbon price should be at the fuel switching level, then carbon should be much, much lower than here. But of course, then you come into this other kind of the supply and demand balance for carbon in the future years, just because of the setup of the EU ETS directive.
Yeah, exactly. So, but you also mentioned sort of coal being out of the money. I mean, there's very little coal, but there's certainly drastically reduced coal-fired electricity generation in Europe. So that, the fuel switching from coal to gas isn't really, as you mentioned, not a driver though anymore.
So, gas could go up quite a bit without more emissions coming into the power sector for the EU ETS at the moment. So that's why it shouldn't really be that correlated at the moment, but it is.
But it is, yeah. And, I think you see very closely that across Europe, people are expanding renewables generation. We're seeing, negative prices in the power sector, huge amounts of solar and also wind coming on stream. Do those kind of short-term factors influence the carbon market at all?
Yeah, now we're a bit on the shoulder season, so in that sense, it does not have too much impact at the moment.
Shoulder season,
but we're out of winter. So winter, typically when we have heating demand, and then in the summer when we have cooling demand, and of course then you see the weather forecast having more of an impact. So more or less wind, or how much emission-free power generation is available, especially in the high demand seasons. So of course we have seen previously that has had an impact. Typically when the new weather forecast is coming in, that is influencing not only kind of gas or gas coal power market, but also carbon for reasons why more or less emissions based on the availability of emission-free power generation, so nuclear and renewable power generation.
I guess the sort of $100 million question is then, Ingvild, where are we going now in terms of prices? I mean, where do you expect to see prices sort of now as we maybe leave the shoulder season and go into summer and then in towards winter?
Yeah, so there are a few factors that I think will play in. First of all, the weather will of course be important for summer. If we suddenly get into heat waves where we have like high demand or more fossil fuel generation, that will have a bullish impact on prices, and vice versa, I guess. But then it's also this Repower EU measure. That is this extra sale of allowances to the market to partially fund the Repower EU plan. And of course, these volumes that is added to this year's auction calendar, that's based on the €75 carbon price. Now the average carbon price so far has been just above €60. So that means they're falling short with the monetary target for Repower EU. So that means in a sense that they need to add more volumes to the market to reach this 20 billion target that they have set for as a monetary target for the sale of EU allowances.
So what is the Repower EU? What is that all about, Ingvild? For those listeners who may not be familiar with that part of EU policy.
Yeah, so that was EU's response to the invasion, the Russian invasion of Ukraine. When we had the energy crisis, the need to, with the high dependency on Russian gas, especially to wean off EU at a faster pace and increase the energy security for Europe. So increasing the speed of renewable build-out, increasing infrastructure, and of course that comes with a price as well. And some of that funding will come from the Recovery and Resilience Fund that was set aside for COVID and other measures as well. But part of the funding was also earmarked to come from the EU ETS, so the sale of allowances. I think the big problem was that they set like a monetary target. So 20 billion euros should be reached within August 2026. And of course, that means we don't know exactly what volumes will need to be auctioned to reach this target. And then when this year started with lower carbon price, and then we saw prices were dropping, and we've been down to, as you said, 50. Of course, then the buzz in the market is, okay, how much more volumes will come to a market in a market where we really don't need these extra allowances that will be brought to the market. So the EU ETS is by default quite complex anyway, and then adding complexity on top of that with Repower EU. And of course, in short term that's bearish, but also in the long term that's tightening the market quite considerably also, because you're borrowing allowances, you're bringing in allowances that was supposed to be auctioned in the future and auctioning them now instead. So I think that's been one of these a bit tricky thing, both for the market to assess and for us as analysts to assess a bit when will potential additional allowances be brought to the market. We have an assumption that we think the EU Commission will keep the auction calendar as they is for 2024, so that the extra allowances will be added to 2025. But we don't know for sure because we don't have the information. In the auction regulation, you say you can update the auction calendar throughout the year. So one could be when they update the or adjust the auctions with the auction with the market stability reserve adjustment from September. That could be one event that they can also increase the volumes, but we don't know for sure.
So this could increase volumes by what? If you're saying if they're measuring a price based on a price of 75 euros, so it could be anything between 20 and 50% of extra volume coming on top of into the market.
Yeah, so it's so that's the big ask, because they will use the actual auction price of the 6 month when they adjust the volumes. So in that sense, that's creating quite big of uncertainty for what will the prices be for the rest of the year. How much will the prices be next year? Will you have a full auction until August 2026, or will you have quite little, depending on the price, also in 2025 and 2026? So that's the big unknown and big X for the carbon market in the short term, I would say.
A big if there, but what you're saying then we could be still within this sort of 50 to 75 range then in 2024 and 2025 due to this extra volume coming in?
Yeah, so the annual, if you look just at the annual balance, we have a oversupply this, or it's coming more. It's a oversupply this year, and we assume that will be even larger next year. However, because we're running into quite a big shortage already in 2026, so we expect prices to, or that the market need to take this into account already, especially in 2025. So we expect prices to increase then in 2025 25 compared to where we are now. So that's the because of course this is like a bit kind of resemblance to when we had the start of the market stability reserve, where kind of market participants were starting to prepare ahead of the shortage in 2019. So I think talk to quite a lot of market participants, and they see this shortage will hit the market. So it is more dependent on when will the price turn, or when will that be factored in, more than that it will stay at these levels forever.
So you would say before the market tightens in 2026, the end of the Repower EU program, so that would be a good time for many investors potentially, or people come in to enter the market at this time while prices remain fairly low, because the expectation is from 2026 they will go up.
Yeah, because it's, we started the Fit for 55 framework this year. So, that's already tightening quite a bit, like year by year. And then in 2026, and on top of that, you have the market stability reserve that is like acting or reacting to both kind of the drop in demand. It will treat the Repower EU as a supply shock. So it will work on these volumes. So that will especially like when you talk about kind of Repower EU, that we see quite strong MSR in the years to come. When you are in the years where you have to pay back the Repower EU volume, you're decreasing the cap quite rapidly. You will have the second rebasing in 2026. You will have like the full inclusion of maritime sector that will come with 40% this year, 70% next year, and then 100% in 2026. So that's, of course, and then you have some like bits and pieces with like some readjustment of the maritime cap, and like all these things are coming at the same time. So 26 and 27, it's like quite a lot of these tightening elements that will hit the market at the same time. So even if we see emissions are dropping fast, but it needs to drop fast as well to remain within the cap, right?
And the trajectory for emissions. And so this, if I understand you correctly, Ingvild, you're saying this, we could easily then see prices go to 100 and beyond post 2026. Interesting, very interesting. I think so. But you mentioned as well earlier about the sort of investors and their short positions. So every week we get these sort of figures come out, and you know what's happening here? Why the expectations that prices will fall?
Yeah. So this week we saw, or the latest commitment of traders numbers that came in this week. We saw in investment funds were actually decreasing their net short positions. So they were adding both kind of on the short side and on the long side, but totally like the net shortage is decreased by, I guess, 1 million or so.
What does that mean for the market? And what kind of an indication is that, Ingvild?
It's a good question, because investment funds are holding like a relatively, relatively small part of the market, but it has become kind of an increased one of these like increased factors that market participants are watching. Of course, when they were re-entering the market, when prices were rallying, they were more on the building up on the long side. Now it's reflecting that they have also a short view on the market as well. And also this kind of the risk of the short covering, for instance, is kind of some things that people are bringing up as well. But it's I guess it's giving some indication, but not the whole picture.
Yeah. No, that's fair enough. You also see, does that to some extent explain why prices move so much on a daily basis? They can be up or down €6 in the course of a day, which on some days represents close to 10% of the value of the actual commodity of the carbon allowance.
Yeah, it's I think maybe not only the investment fund, but it's of course it's quite a lot of technical trading on top of things. So sometimes you just need a spark from, for instance, the gas market, and then you move across some levels that will increase the or amplitude of the market.
And are you seeing any kind of change in hedging behavior from big utilities? Because previously they would hedge many years in advance. Now with the onset of much more renewables coming into the system, big utilities are greening their portfolio. What does that mean in terms of hedging their carbon emissions?
Of course, their hedging need is less expected emission-intensive power generation. And of course, that's also what we've seen a bit the beginning of the year as well. So, I mean, suddenly you have, even for 2024, you have probably decreased your expected generation for 2024 just by seeing how rapidly the need for fossil fuel, especially hard coal, has been for 2024. And we see also it's a decrease because, I mean, the cleaning of the power sector is happening regardless. So that the hedging needs are getting lower and lower, yes.
And that's also then reflecting in the market in terms of lower demand and potentially less liquidity as well?
I mean, yeah, we've seen the open interest has decreased a bit. But of course, we have different market dynamics also possibly kicking in as well. We have, for instance, industry sectors, which for now has received quite a lot of free allocation. Now the free allocation is decreasing, and then we have the CBAM phase out. So in what way will, for instance, the industry players be able to hedge their carbon price risk for the future? And then we also have shipping sector. I mean, even if it's relatively small, it's typically a sector where you have hedging strategies in place already for fuels. So possibly some increase in hedging from shipping. So I think it's just a different kind of the dynamics. It's changing a bit, and that's where we're also going from a more power centric EU ETS to a more industry centric EU ETS.
Yeah, that's very interesting, I think, because there's always been the power sector has been one of the main drivers, but if that's going to come from industry, that's an interesting change. A final question, Ingvild. We're sitting here in Oslo. It's a bright, sunny day, a very welcome sunny day. But we're ahead of the summer. Now, summer is traditionally quite sort of low liquidity, and quite volatile, as you mentioned, also because of if we get a heat wave, it has dramatic effects or has large effects or large impact on generation from nuclear and coal plants. So, but you have the new compliance deadline, which is right after the summer. That could produce more volatility in prices. What do you think about that? What do you expect for the summer months?
Yeah, so it's very interesting because now it's the first year we were seeing kind of compliance and September. So that's new. We have seen a bit kind of an uptick in interest for the August future contract, but not very much. Normally it has been kind of March that has been the second largest. But of course, just being in the market for quite some while, it's been this always this psychological effect, even if the buying needs not necessarily have been huge, but it's always this thinking that someone needs to go into the market and buy ahead of compliance. It's always been this psychological factor that has often been a kind of a support to prices. What is also changing is that normally August is half volumes or auction volumes, but that has changed now. So now it will be full auction volumes in August to accommodate for kind of a later compliance period. So it will definitely be interesting to see both how will demand at auctions be, especially in August when it's normally halved volumes. And then that we potentially can have some support from the delayed kind of compliance deadline.
Well, we shall see, indeed. It'll be exciting times ahead, Ingvild, both in the short term and from 2026 onward when the market will certainly tighten. Thanks very much for being a guest on the Montel Weekly Podcast.
Thank you.